you're a US citizen or a green card holder and you plan to invest offshore, what I'm going to do in this video is break down the pros and cons of offshore investing, reporting requirements that must be met regardless of where the account sits, investment restrictions that can apply and the reasons for it, and also understanding different tax treaties. So firstly, as an American, you must report foreign accounts and assets, not just domestic, and you're also liable to pay tax on your global income. So just because you have a foreign account, it doesn't mean that you don't have to report it, and it also means that you don't pay taxes. The tax rate you pay will depend on what the treaty says. So you've got to look at the US treaty with the country where you're living and then break down what the different assets are. So retirement accounts, investment accounts, social security payments, estate taxes, all of these are going to be taxed differently. And there are three outcomes. One is there's no treaty at all. So if there's no treaty with the US and the country where you're living, it means you may end up paying tax twice. There could be reductions by using things like foreign tax credits, and this just means you can offset tax in one country against the other. Or the third is there could be, for example, a complete elimination from local taxes. So social security payments, they could be taxed in the US, not in your local country, and that does create some good planning opportunities. When you're adding a third jurisdiction, which is where your offshore account sits, it can become more problematic, but the benefit of using offshore jurisdictions is, generally speaking, these are in tax neutral places. And what I mean by tax neutral is there's no capital gains tax, no tax and interest, no dividend tax, so no tax whatsoever, which means even if there is no double taxation no tax treaty, and the tax rate's 0%, it's not really the end of the world, because okay, you get taxed twice, but you get taxed on the normal rate and also the 0% rate in the tax neutral jurisdiction. Not all tax neutral jurisdictions are the same though. So you've got some which are blacklisted, some that are grey listed, some that are white listed. You want to make sure that you work with a compliant country which follows the tax transparency rules and also anti-money laundering standards. But investing offshore does have other complications. So as an American, you can have an offshore account, but what you wouldn't want to do is buy offshore funds or ETFs. And the reason for that is because these are classed as PFIC, which stands for Passive Foreign Investment Company. Because if you do buy those, any gains you realise won't be taxed as capital gains tax, they'll be taxed as ordinary tax rates at your highest rate. So you're going to end up paying more tax by having an offshore fund or an ETF. What you can do though is buy direct stocks and direct bonds, but it makes the account a lot more difficult to manage, because if you're buying, for example, 50 or 80 different stocks and bonds, you have to know when to sell and when to buy. One way of shortcutting this is, because outside of America it's very difficult to buy US funds and ETFs, you could use a money manager who has access to PFIC compliant solutions, and they may be able to buy US domicile funds or ETFs. But if your main reason for investing offshore is to mitigate currency risk, you have to ask yourself, is this doing this at all? Because if you're buying, for example, US stocks or US funds and ETFs, and the account is set up in euros, for example, and it isn't hedged at all, you've actually not eradicated this risk at all. And if you're only holding US stocks, there is literally no currency mitigation at all. There are certain strategies you can adopt. So you could use, for example, FX forward contracts to lock in certain prices. But again, this strategy is really, really complex. If you are just looking to move your money offshore because you want some money outside of the US, a lot of these offshore jurisdictions they have a lot of consumer protection. So it could be up to 100% of your assets that are ring fenced, which means in the event of bankruptcy, your funds are not a risk. But again, it depends on the jurisdiction, and it also depends on the custodian that you're going to be using. So if you are looking to find out more information on this subject, please reach out to us.